A new law, signed in 2025, created a $6,000 bonus deduction for Americans 65 and older. And for a lot of retirees living on Social Security, plus a modest pension or small investment income, that deduction is enough to bring their federal tax bill to zero. Nothing owed. The IRS is not going to mail you a letter explaining this. Your tax software may not trigger it automatically if your date of birth is missing from your file. And if you already filed your 2025 return without it, there is a way to go back and claim what you missed. That is what this video is about. My name is William Hayes. For more than 20 years, I have prepared returns for retirees and watched the same expensive misunderstanding cost honest people thousands every year. I am an enrolled agent, which means I am federally licensed to represent taxpayers before the IRS. Not a salesman, not a broker, not anyone who benefits from your confusion. Just someone who has sat at a lot of kitchen tables with a lot of people who are paying taxes they did not legally owe, and who wants that to stop. What I am going to walk you through today is real. The deduction exists. It has a number. It has rules. It has an expiration date, and it has an income phase-out that means some of you will not get all of it. I will cover every one of those pieces so you know exactly where you stand. Before I go further, if you are not subscribed, please do that now. This channel covers Social Security, Medicare, IRS rules, and senior tax issues. Not motivational content. Not investment tips. Actual rules, actual numbers, actual forms. If that is useful to you, subscribe, and you will see the next one. One more thing before we get into the mechanics. I want to clear out two beliefs that I hear from retirees constantly, because either one of them can cost you money if you hold on to it. That was true until 1983. Congress changed it that year. Today, depending on your total income, up to 85 cents of every dollar of your Social Security benefit can be included in your federal taxable income. That is the law as it has stood for decades. If you have been assuming your benefits were untaxed, the first thing to do is check. Pull out last year's return and look at line 6B of Form 1040. That is the taxable portion of your Social Security. If there is a number there, you are taxed on your benefits, and this new deduction may offset all of it. I hear this more than you might expect. People have been let down enough times that they assume any headline about a new benefit is either a scam or aimed at someone richer or younger. This one is real. It is in the tax code, and it is specifically aimed at middle-income seniors, the people in the middle of the income range who earn too much for some assistance programs, but not enough that they do not feel the pinch. The very high earners actually phase out of this deduction entirely, which I will explain in a moment. If you are a retiree on a fixed income, the odds are good this was written for people in roughly your situation. Now, who does not benefit? Two groups. First, seniors whose income is already low enough that the existing standard deduction wiped out their tax bill before this new deduction even existed. For them, adding more deduction does not change anything. Zero was already zero. Second, seniors with modified adjusted gross income above $175,000 if single, or above $250,000 filing jointly. The deduction phases out completely before you reach those numbers, starting the phase out at $75,000 for single filers and $150,000 for joint filers. The sweet spot, the people this helps most, are the ones in the middle. Single seniors with income roughly between $20,000 and $75,000, and couples with income roughly between $35,000 and $150,000. Here's the deduction itself, as clearly as I can state it. The law is formally called the One Big Beautiful Bill Act. It was signed in 2025. Among other things, it created what is being called the Senior Bonus Deduction Gov. I will have the link in the description. The deduction is $6,000 per qualifying individual. You must be age 65 or older by December 31st of the tax year. So for the 2025 tax year, you must have turned 65 on or before December 31st, 2025. For the 2026 tax year, on or before December 31st, 2026. Same logic each year. If you are married and both spouses are 65 or older, you each get $6,000. That is $12,000 total for the household on a joint return. The deduction is available whether you take the standard deduction or whether you itemize. That matters. You do not have to choose between this and your mortgage interest or charitable contributions. It stacks on top of whichever approach you already use. Now here is where it becomes relevant to Social Security specifically. To understand why this deduction can zero out your Social Security tax, you have to understand how those two things interact. For the 2025 tax year, the standard deduction for a single filer is $15,000. If you are 65 or older and single, you get an additional standard deduction of $2,000 on top of that, bringing your total to $17,000. Now add the new $6,000 senior bonus deduction. Single filer, 65 or older under the income phase-out. Your total deduction stack is $23,000. For a married couple where both spouses are 65 or older, the base standard deduction is $30,000. Each spouse gets an additional $1,600, adding $3,200. Then both get the $6,000 senior bonus, adding $12,000. Total deduction stack, $45,200. Now think about what a typical retiree couple's income actually looks like. Say they collect combined Social Security of $32,000 a year. They have a small pension that pays $18,000 a year. Total gross income, $50,000. Of that $32,000 in Social Security, the provisional income calculation determines how much is taxable. And for many people in this income range, up to 85% or $27,200 ends up in their taxable income. Add the $18,000 pension, you are looking at around $45,200 in taxable income before deductions. Their deduction stack, as I just described, is $45,200. Tax owed, $0. That is how effectively tax-free Social Security works for many people in this income range under the new law. It is not that Social Security itself was removed from the tax code. It is still technically taxable. What happened is the deduction stack grew large enough that it offsets the tax for a significant portion of middle-income retirees. For many people in the middle-income range, that is accurate. For people at the higher end, it is not, and I am not going to pretend otherwise. I want to be clear about two things. First, this is a deduction, not a statutory exemption of Social Security. The underlying taxability rules did not change. Second, this deduction expires after 2028. Unless Congress extends it, the senior bonus deduction is not in the law for 2029 and beyond. Plan accordingly. One detail almost nobody is mentioning. Your tax software or your preparer must have your correct date of birth on file to trigger this deduction automatically. If your birth date is wrong, missing, or never entered in the system, the software will not apply the deduction. You will not get an error. You will just get a return that does not claim what you were owed. I have already seen this happen. That question is worth asking. I want to tell you about a man I will call George. George is 68 years old and lives in Akron, Ohio. I am using composite details to protect his privacy, but this scenario is representative of real situations I have seen. Last year, tax year 2024, filed in early 2025, George owed $1,840 in federal income tax. He paid it. He did not love it, but he paid it. His income that year was Social Security of $22,400 and the pension from his former employer of $21,600. Total, $44,000. For 2025, the first year the senior bonus deduction applies, George's income stayed roughly the same. Social Security of $22,700 after the annual COLA increase. Pension still $21,600. Total income, $44,300. Under the old rules, after calculating the taxable portion of his Social Security and applying the standard deduction plus the existing OVER 65 additional deduction, George would have owed somewhere around $1,700 again. Under the new rules, George's preparer stacks the new $6,000 senior bonus deduction on top. His total deduction is now $23,000, the $15,000 standard deduction, plus $2,000 for being over 65, plus $6,000 senior bonus. His taxable income after deductions, approximately $5,700. At his tax bracket, that produces a federal tax liability of around $570. But he also had $1,200 in federal withholding taken out of his pension payments during the year. Result: George gets a refund of around $630 instead of writing a check. $1,200 difference from one year to the next, with the same income, because of one new deduction his preparer knew to apply. George is not wealthy. He is not sophisticated about tax law. He is a retired machinist. who trusts whoever prepared his return to catch these things. In this case, his preparer did. Not everyone's does. Now I want to talk about what happens if your preparer did not catch it. The 2025 tax year return was due April 15, 2026. Many of you have already filed. If your return was filed correctly with the senior bonus deduction applied, you are done. But if it was filed without the deduction, because your preparer missed it, because your software did not have your correct birth date, because you did not know to ask, you may have overpaid. The mechanism to fix this is Form 1040-XS Individual Income Tax Return. You have 3 years from the original filing deadline to file an amended return and claim a refund for taxes you overpaid. That means for the 2025 tax year, the window runs until April 15, 2029. Here is how it works. You or your preparer prepare a corrected version of your 2025 Form 1040. The 1040-X shows 3 columns: what you originally reported, the change, and the corrected amount. You explain in Section 3 of the form what you are correcting, in this case, claiming the senior bonus deduction that was available but not claimed on the original return. If the math shows you overpaid, the IRS processes the amended return and issues a refund, with interest if it takes them more than 45 days after the return is processed. Processing times for amended returns have historically run longer than original returns, sometimes 4 to 6 months. File it right, file it once, and wait. One caution: if your original return had other errors or issues, an amended return opens the whole return to review, not just the item you changed. If there is something else on your 2025 return that was wrong, income you forgot to report, a deduction that was aggressive, talk to a qualified preparer before you file a 1040-X. In most cases, if the return was otherwise clean, amending it to claim a legitimate deduction you missed is straightforward. The deduction also applies to the 2026, 2027, and 2028 tax years, so this is not a one-time issue. You need to make sure the deduction is claimed each year you are eligible through 2028. Here is what I want you to do this week. 4 steps. Step 1. Confirm your date of birth is correct in your preparer's system or in your tax software. Call them. Ask. This is not a strange question. It is a basic data check that prevents a real mistake. Step 2. Pull out your 2025 return, or call your preparer and ask specifically whether the senior bonus deduction of $6,000 was applied. It should appear as an adjustment to income or as part of your deduction calculation. If they are not sure what you are talking about, that is useful information. Step 3. Check your income against the phase-out. If your modified adjusted gross income was under $75,000 as a single filer or under $150,000 filing jointly, you likely got the full $6,000 per qualifying person. If you are above those numbers, the deduction phases out on a sliding scale, fully gone at $175,000 single and $250,000 joint. Pull your 2025 return and look at your adjusted gross income on line 11 of your Form 1040 to get a rough sense of where you stand. Step 4. If you need help and cannot afford a paid preparer, use the free resources. The IRS Tax Counseling for the Elderly program, TCE, provides free tax preparation, specifically for seniors 60 and older. AARP TaxAid is the largest TCE provider and operates sites across the country, including libraries, senior centers, and community centers. .org/money/taxes/AARP TaxAid-locator. These are trained IRS certified volunteers. They know this deduction exists, they will apply it correctly. If you already filed and suspect you missed the deduction, a TCE or AARP TaxAid volunteer can help you assess whether an amended return makes sense. They prepare 1040-X returns as well. This is general education, not personal legal, tax, or financial advice. These rules really do vary by state and by income. Always confirm your own situation with your county, your state SHIP office, the IRS, or a qualified professional before you act. Being legally entitled and actually having the money are 2 different things. The only bridge between them is the form, and the agencies are not going to build it for you. So we will. If this video helped you, share it with a parent, a neighbor, a friend who is retired or close to it. The people who need this information most are often the least likely to stumble across it on their own. In the next video, I am going to show you the exact income levers that determine how much of your Social Security is taxable in the first place, the provisional income calculation, and the legal moves available to lower that number before it reaches your return. That video goes deeper on the mechanics. This one does not have time to cover. It is the companion to what you just watched. I will see you there.